Hello, hi everyone. This is the second part of understanding the Polycab wires and cables business. Earlier, what we have discussed already, where we covered that what is the Polycab's market cap and what is the valuation at which Polycab has been trading, and what is the ROE, ROC. Next up, what we have seen is the peer comparison for Polycab India. The major competition is coming from KEI wires and the other small players who are gaining the market shares recently. So this is what we have understood. Now in this video, the agendas will be like understanding the financials of the company in terms of profit and loss, balance sheet, cash flow statement, and then gradually we will reach to what are the future growth levers that will have Polycab on a greater profit. So next up, we have the profit and loss statement for FY24. So F24 it has a 180 billion rupees revenue. It is and the highest ever PAT has been achieved by company. So first we will understand that what is the growth percentage of revenue which Polycab has been able to deliver in financial year 24. The financial year 24 is very good for Polycab India in terms of revenue as it has grown 28% year on year. Also, you can say the quarterly growth in earnings both sequentially and year on year is around 29%. So Polycab India has been able to clock a revenue of 180 billion rupees. So whatever and that too translates in its EBITDA multiples. So EBITDA, if you look at, has been grown by 35%. So there must be some operating leverage which is helping EBITDA to grow higher than what the revenue increase is. So that operating leverage has been playing out for Polycab India. So again, you can look at similar growth has been achieved in year-on-year and sequential growth. So the margin has also improved from 13.1% to 13.8%. That is due to operating leverage which Polycab India got from the revenue growth. So again, the similar play which we can see in PAT terms, that where your fixed costs such as depreciation and interest remain same, your taxation is a variable component, so your PAT growth will be higher than what your EBITDA or revenue growth is. So that is also beneficial to Polycab India. If you look at what's the year-on-year growth that for PAT is, it has grown to 1800 crores PAT it has currently, and in last year it has around 1283 crores of PAT. So PAT margin has also grown. So this is very good news for the company that both operating leverage are working on your EBITDA and PAT multiples. So what has helped Polycab India in current financial years to grow? So you can understand that the game of cable industry is also dependent on the demand. So demand growth in terms of volume has been the core reason for Polycab India to grow. So where they have registered the 28% growth year on year and achieved the milestone of 180 billion revenue. So again, EBITDA has been played out very good due to some price revision as well as the product mix change which contributes to your margin. So that has also helped, and also the operating leverage and lower advertisement and publicity spend they have reduced. And again, if you look at in the profitability perspective of PAT, which is improved, so this is also a reason of your strong uh, fixed cost support which has given you the PAT margins you require. So again, moving on to the next slide, this is your uh, revenue growth, which is at 28%, 35% is your EBITDA, 41% is your profit after tax growth. Next up we have is key highlights. So key highlights where company is covering its market share. So company has gained market share of around 2 to 3%. So this is significant market share gain. If you look at companies almost now owning one-fourth of the market share of full cable and wire industry. So company is growing on its own and also taking the market share from the competition. So this is very good for the company to represent itself as the market leader going forward. So what market share is out of which market? So this is gains in domestic organized cable and wire industry via strategic internal initiatives. So whatever initiatives company has taken, they have been able to gain the market shares. Maybe they have increased some dealership or again some capability building which company did, and also some quality improvements which would help company to gain a market share. So again, EBITDA margins has also been improved because of your better product mix and your operating margin. CapEx, if you see, company has invested 4.6 billion in previous financial year, and in this financial year, company has invested 8.6. This is almost double to capture the robust demand opportunities which are present in current market, where the infra spend as well as your domestic spend and consumption of cables and wires will increase, as well as the electrifications in all over the country will help the company to grow itself. Then again, if you look at the dividend payout, company is paying additional 50% dividend in terms of last year's dividend. So that's also a positive sign. The company as a pattern has already grown at 41%. Then business mix, if you consider that cables and wires is considered of almost 88% of the business, FMECG is 7% and 5% is other businesses, that is the EPC businesses company operates in, and more of sales is domestic and international, that's close in 92.8%. So I think key takeaways from here is that 88% is coming out of cables and wires, 7% dependency on FMECG, which is a new segment company has entered and ventured in, I think, 2 to 3 years ago. So that's also good. So now, what investor get in last 5 years? So 5 years back, company got listed, and the CAGR return on company has brought in 63%. So this kind of return you can make if you are investing in high quality companies which are generating tons of cash flows every year and reinvesting it for the future growth of company. So there has been higher highs which company has achieved in terms of profits growth, revenue, and your market cap follows that. So this is a simple logic. If you are earning greater than your previous profits, so market will reward you. If you look at the returns of Polycab, it has given 886% return over the 5 years, whereas the Nifty 500 index is the closest to it, which has given 208% returns. So this is by far crossing it 4 times higher than the indexes it's benchmarked against. So that's the sort of returns you would be able to make if you are investing in such high quality companies. That is the gross advantage you have. So keeping that wealth aside, we move forward. Next is what are the growth engines which are helping Polycab do what it is doing in terms of revenue growth. So what's driving it is infrastructure-led development, which the government is also focused on, and also we have looked in the budget for financial year 25 that varied focus on infrastructure spends both in terms of defense, railway, and your interconnect connectivity between the cities, which is increased. So power plant, railway, roads, highways, airports. This is increasing, and commercial and urban development is also on a rise. So malls, administrative areas, commercial building, public works departments. These are also key factors which will increase. Specialized projects such as defense battery, charging unit, and again you are having mining, navy, tunnel, temple, energy and power, where we have greater demands arise. Electrification is a big thing happening in India, both in terms of your commercial as well as residential. So again, education and research, education and research institutes, opening of that will also increase utilities such as core education. These all factors are actually helping the company to grow its revenue faster than ever. So next up we have the seasonally strong quarters. We can skip this part maybe. There's no need to cover that. So I'm coming on to the balance sheet, detailed balance sheet of the company. What we have seen is company is investing around uh, 8 billion rupees this financial year. So to look at that growth, we can understand that from here. So the fixed assets, if you look at it, 23,000 crore it was standing earlier, now it is at 29,000. So that growth can be seen in the fixed assets. In the non-current assets, as well as if you look at the inventory is growing, but year on year sequentially it has dropped. So again, trade receivables, if you look at this, is also growing with my revenue levels are also up. So I have to look at the DSO ratio, that where it is standing. Cash and bank balance has been reduced, further reduced, and shareholders wealth is actually increasing. Next up is your cash flow statement. So cash flow statement for whole year, if you understand that company is having a free cash flow of 120, uh, 1296 crores, and against that we have a cash outflow from investing activity, that is 7,519 crores. So this is something to look for. The company is highly investing in your fixed assets. Other key data points: company's advertisement spend. If you look at it, has been reduced, which company is saying that they will reduce against the revenue percentage. Capex is again, you can look at it in the figures are in millions, so this is 858 crores which is spent this year. Net cash position has been increased because they have reduced it. And then goods in transit, doesn't matter what export revenues increase, but the contribution percentage has gone down. Amigos. So this was a comparison between F23 and 24. And we've also looked for the growth levers which can lead Polycab to high rise. We'll also provide a detailed video on the analysis of cables and wires industry, where we can discuss the growth which is targeted in that industry currently and what we are looking for. So that can be understood through that. So again, I think we have covered almost everything on Polycab. Uh, and if anything is left out, please reach out to us, and we will be able to